Hi everyone, my name is Robin Speziale and I'm a national best-selling author of a book called Market Masters. In this video, I'll be talking about merger and acquisition risk arbitrage. And risk arbitrage is a way to generate supplemental returns in your stock portfolio. And this would be in addition to your core investment strategy. And what I do is I go long, I invest for the long term in growth companies. And these aren't just any company. These are micro, small, mid-cap companies. So companies ranging from 50 million in market cap all the way up to 10 billion. And this is the majority of my portfolio. And these companies are all achieving a high return on equity, and they're growing nicely. I take a look at earnings per share, book value per share, and free cash flow per share growth over a 5 to 10 year period. But to supplement my returns in my portfolio, I've also participated in what's called risk arbitrage, and you can even extend that to speculating about takeovers. So let's get into it. The market is it's a very dynamic place, the stock market. There's different opportunities to make money. And as I said before, as a result, you can supplement your basic long equity strategy with other repeatable strategies. It was clear when I wrote Market Masters and I met with a bunch of hedge fund managers, private investors, mutual fund managers, that one of their alternative strategies was merger and acquisition risk arbitrage. But keep in point that this form of risk arbitrage is not as prevalent, or you can't capture the same high gains as you could before in years that have passed, perhaps because of heightened awareness, or most probably because of higher frequency trading and algorithms that squeeze these spreads, that limit the opportunities you can capture in the market. Martin Braun, somebody that I interviewed in Market Masters, he's a hedge fund manager at Adelaide Trust. Martin said every time a company announced it was being acquired, it would go into a database that he managed, and we'd go trolling, looking for the best spreads with the least risk. It didn't take me very long to figure out that I didn't just have to trade on announced deals, acquisition deals. I could also trade rumored deals or theoretical deals. So here's how it works. Now, this merger and acquisition risk arbitrage, and you can actually learn from this and use this as a strategy in your own portfolio if you're a do-it-yourself investor. So, for example, when company A announces its purchase of company B for X amount, company's B stock price will rise close to, but not exactly at, the announced X amount. That's because there's still risk that the deal won't actually close, combined with the existence of time value of money, or in other words, opportunity cost of having one's money tied up. What one can then do is purchase stock in company B. Okay, so this is the stock that it was announced company A was going to acquire. And then you wait until the deal finally closes, and then you collect the spread. So to detail how this could work, company A says, we've placed an offer to buy company B for $25 per share. So the market, you can check the market, and because of algorithmic trading and because of heightened awareness, this is public news, and the price of the stock might immediately go from what is currently trading 19 to, let's say, $24.50. So the spread will be 50 cents per share. Okay, so as we said before, because of different variables that are unknown, the deal might not actually close, the acquisition deal. The price of company B won't go directly and all the way up to $25 per share. After news comes out, it might go to $24.50 per share, thus leaving a 50 cent spread. So a gain that you can possibly pocket by investing in company B and then waiting for the deal to actually close. And then once it closes, you have the opportunity to pocket that 50 cents. And this is just an example. So that's risk arbitrage. Like, it sounds simple, but again, you need to assess the probability of the deal actually closing as it was announced to the public. So Jeff Stacy, an investor who I interviewed for my book Market Masters, he enters into a wider range of multi-strategy plays in what he calls event-driven transactions. So he says that event-driven transactions are the pursuit of profits from announced corporate events. So it's not just company A acquiring company B. He also takes part in these type of event-driven transactions, so liquidations, again, mergers, acquisitions, which we talked about, recapitalizations, tender offers, anything really where you can say, okay, if this event happens, we're going to make this amount of money in this amount of time. So I hope this helped, guys. We talked about merger and acquisition risk arbitrage, and it could be a way or a strategy you can use that complements your core investing strategy to generate additional returns in your portfolio. If you have any more questions, you can contact me at r.speziale@gmail.com, or you can check out more investing posts on my blog at robinspeziale.com. Thanks.